Commercial dumping, fiscal dumping, or social dumping. What does it mean? Let's start with the commercial dumping. First of all, to dump means to simply to throw something or to rubbish something. Then we can say that the commercial dumping is indicative of loss on sale. That is to say, exporting products abroad and apply a price lower than what is in the domestic markets. The commercial dumping is divided into three categories. Predatory dumping, which is a form of unfair competition where the company deliberately asks for a lower price abroad to crush the competition. The second is called sporadic dumping, a situation of temporary production overcapacity that the company faces by selling its products at a better price abroad. The third dumping is called persistent dumping. As its name suggests, it's the most permanent type of dumping. It involves selling consistently at lower prices in one market than the rest of the markets. Thus, the objective of adopting dumping would be either to monopolize the market or to conquer market shares or to defend threatened markets. It is then the unfair competition. For this reason, the World Trade Organization has authorized anti-dumping as measure to counteract this practice. Among these measures, countries can impose anti-dumping duties or countervailing duties in order to protect the domestic industries. The states can also apply what we call the embargo, from which a country can introduce a measure prohibiting the importation of particular products into the national territory. An emblematic example is the Russian embargo of 2014 against the European Union. In this context, Russia has banned basically food products from the European Union. Now, let's move on to another type of dumping, this time called fiscal dumping, which is a part of fiscal incentive policy. We then talk about what is we called the tax haven, when a country whose tax rate is considered very low in order to increase the country's competitiveness. Let's now move on to a social dumping, which means that a company seeks to minimize its costs by hiring workers from other countries to pay cheaper contributions or to ultimately increase its turnover. So, the social dumping emphasizes the importance to use very cheap labor than when it's available in the domestic product. To make simple, imagine a Moroccan company that seeks to hire an accountant in normal times. It will practically turn to hire a Moroccan accountant. However, if the company decides to practice social dumping, it will recruit a Guinean accountant who will work in Morocco but who will receive his salary equivalent to Guinean. His social contribution will be paid in Guinea. This would allow the company to decrease its costs. Thus, the repercussions of social dumping will be either the loss of jobs in rich countries, the industrialization of these countries, or the exploitation of the southern workers in human conditions.